pensions and the new tax rates. In this video I want to look at whether you should pay money into your pensions now or a little bit later as a result of the increasing rate of corporation tax. I do regular videos on tax and accounting issues, so if you'd like to be kept up to date, please subscribe to the channel, and hitting that like button, it really helps me and the channel, so please, if you could do that, I'll be very grateful. This video is about pensions. So why am I worried and stressing about pensions when the tax rates go up? Well, in simple terms, if you put money into your pension now, if you were to put £10,000 into your pension now, you'd get corporation tax relief at 19%. So you get £1,900 of tax relief, hooray! But if you wait until the tax rates go up at 25%, you get £2,500 of tax relief. So you're getting £600 more tax relief if you wait until the tax rates go up. So that sounds attractive. And I think for a lot of people, they will delay their pension payments for that very reason. You get more tax benefit if the tax rates are higher. But of course it's never as simple as that. Oh no. There's more complication that I'd just like to add. So first of all, let's just think about it. The tax rates go up in 18 months time, so from April 2023. It also relates to your year end. So if you've got a year end that's not a March year end, you might have to wait until your year end passes before you get the full impact of the increase in the corporation tax. So you might have to wait quite a long time before you make your pension payments. Now that has other impact, because if you're making, particularly if you're making small regular pension payments, first of all it interrupts the compounding that you get within your pension scheme, so you might not want that. You might just spend the money, which so you put money into a pension just to stop your spending. So you have to have cast iron discipline if you're going to wait for a couple of years before you put the money into your pension scheme. It can also be affected if you're putting more than £40,000 a year into your pension and using previous years and old years. You might not actually be able to put as much into your pension as you would otherwise do, so therefore you would just get much less tax relief if you are putting more than £40,000 a year into your pension, and therefore you lose some of those old years. So that's like the main things. I think though, if you have if you got regular payments, I think, yeah, maybe delay them if you do have that tight discipline. I think for the lump sums that you might want to put in, then lump sums you might want to leave until the tax rates go up. And I think within that, you've just got to consider whether you mind, because if you don't put money into your pensions in this year, it means this year's tax liabilities will go up, and you will actually have to pay that higher amount of corporation tax, and that might be something that just hurts a little bit. And don't forget that with the corporation tax increase, so some people are not paying the corporation tax increase. So if your profits are £50,000 or lower, or the pension makes them like that, then you're still on the 19%. So for a lot of small business, very small businesses, they're not actually going to have an increase in the corporation tax. But there's effectively sort of three rates of corporation tax. So it's 19% on profits below 50,000. It will be between 50,000 and £250,000. You'll effectively be paying corporation tax at 26.5%, because by the time you get to £250,000 of profits, you'll pay 25% on all of your income. So that benefit of the first 50,000 gets tapered away. So it might not be 25% tax relief you're looking for in the new regime. It might actually be 26.5%. Ooh. So that might just tip the balance. I don't know. And I think that most of our clients anyway will be Well, the smaller clients will be below 50,000. That will be actually probably most of our clients. But then I think most of the others will be between 50,000 and £250,000. So we'll have a lot of people paying that marginal rate of 26.5%, which is a lot more. It's just a lot more. It's, I don't know, a third more tax that you actually pay. And I think making pension payments and maybe delaying pension payments might be a way of deferring the evil day when you have to make these higher corporation tax payments. And also always consider whether it impacts your mortgage and replacing your mortgage. It shouldn't, but banks are peculiar things, and you just never know how they're going to change the rules. So that's my video today. The increase in the corporation tax will mean that you save more tax money if you delay your pension payments until after the tax goes up for you. And for some people, that's something that's actually not worth a candle. For other people, it might make a few £1,000s of difference, and it's worth the hassle of not investing in your pension and waiting and having the discipline. Thank you for watching. I do regular updates on tax and accounting issues, so if you'd like to be kept up to date, then please subscribe to the channel, and if you press that like button, it helps me and the channel. Thank you very much.